Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Drew, welcome back to the show.
Thanks again.
Today we're talking dividend investing, and this follows on from our passive income series, but it's actually something separate. We did the top 5 Australian shares ETFs a couple of weeks ago, maybe a month or so ago, and now we're doing a similar conversation, but for dividend investing or like yield investing. And the reason why is I received a few emails saying that we should do this for an income focus. We talked about the Vanguard VAS ETF, VanEck, equal weight MVW, and a few other ETFs in that conversation. We have touched on Vanguard VHY, which is the high yield Australian shares ETF from Vanguard. It's the biggest dividend focus ETF in Australia. We're going to talk about that. We're going to talk about some of the other ETFs that are available, but then we'll also talk about one that you're bringing to the conversation, which is a Plato fund. First up, maybe what we can talk about is the differences when you are investing for yield in funds versus just the vanilla index funds and the kind of experience that you get. For example, Drew, people are often surprised that the value of their investment sometimes goes sideways or falls when the market is going up.
Yep.
Why does that happen?
I think I'll say this is a topic that's close to my heart in dividends, being a retiree client base. Everyone wants high income and they want the income to match what they're pulling out. But the difficulty of investing solely for dividends is that you're investing in company. If you're just investing in high dividend paying stocks, you tend to be investing into companies that are paying out all their profit in the form of dividends. And naturally, if a company isn't in reinvesting in themselves and they think there's more value sending the money out, they're less likely to be able to grow like other companies. I mean, there's charts showing Telstra versus CSL. So CSL reinvests about $1 billion a year in R&D, and Telstra pays out about 90% of their income. Both have a role, but I think that's a key reason.
And I think what tends to happen too is people, when they use these funds, they don't always use the dividend reinvestment plans that are available. So sometimes if you're in a fund and you distributed capital gains or something like that, you may end up with a declining net asset value in the fund. And at the end of the year, ETF investors get a member statement or like an annual tax report that's sent, which is helpful because then they can break down the different sources of income. It's important to remember too that when we invest in these types of products, you still get franking credits if the fund holds the position for long enough, but there are taxable events that happen inside the funds that people should be aware of.
I think that's a unique thing as well, that just because you're getting dividends doesn't mean they're buying and holding those dividend stocks and holding them for 10 years. In a lot of cases, there's quite a lot of portfolio turnover. So when you get that distribution, you'd assume it would be 90% dividends and franking. A lot of the time it's realised capital gains that are being paid out, and that's part of that discussion around why the unit price stays flat as well. The nature of these trusts is they have to pay out every dollar of profit every year.
And I think I showed in a discussion that I had recently that if you didn't include the dividends that you'd received from Australian shares, I think that's about 4 out of every $10 is dividends. And then if you include franking credits, which often aren't captured in any of the indices, there are a couple from S&P, that's maybe an extra 2% return per year. So you add all of that up, and all of a sudden the income component for Australian investors plays a huge role in the returns that investors get. So maybe what we can do, mate, is this Plato fund is different. I haven't actually looked at this fund before. So I'm going to be led by you here, and maybe you can just tell us a little bit about it and then who it suits.
Yeah, no problem. So I think Plato is someone we stumbled on probably a decade ago, as we tend to do.
Yep.
I think they're quite rare in finance and investment that they have a very specific focus, and their website makes it clear they're focused on zero tax investors, so retirees, superannuation funds, or low tax paying investors. And they're basically committed with I think 10 or 15, 20 years worth of experience only investing in dividend paying stocks or companies that have got increasing franking credit balances that they expect to pay dividends or make buybacks. So it's very, very targeted. And essentially they hold anything from, I think they say 50 to 120 stocks, usually about 50 or 60, that are either the highest paying dividend stocks at the moment historically, but also looking to grow their dividends as well.
So this is listed on the ASX under the ticker symbol PL8, as in plate. It's the Income Maximiser Limited. So it's an actively managed fund. It's diversified portfolio of Aussie shares. I think I've spoken to these guys via email a few times, and it was clear that was the focus. At the time, I was like, yeah, but everyone's interested in growth investing, so I don't know about this. But
Don Hampson, Dr. Don Hampson is probably one of the more impressive investors you'll see. Just the amount of, it's a data-driven strategy, so the amount of data they have on companies analysing dividend payers, and only they've got a global fund, but are very much focused on Australia. I think is it still a listed investment company as it stands? Which is quite unique. If you've done a session on listed investment companies, they got the ability to keep paying consistent dividends from their own franking reserves compared to ETFs that just pay everything out.
And that makes them a bit more controlled too, because they can smooth the investment experience. But the key is that the net asset value and the stock price can sometimes be disconnected. Yeah,
and I think one of the reason they're focused on those zero tax, so it's been popular with my clients that are retirees and holding within an SMSF, is that they are able to turn the portfolio over more aggressively. So they might hold, say, 50% of their portfolio stable. They might have things like CSL that you never have in a dividend-paying portfolio, but then combine that, like at the moment, they've got Super Retail Group, JB Hi-Fi, these things that are yielding 8 to 10%, and you're turning over a portion of your portfolio for the upcoming dividend payments and making sure you get the franking credits as well. So it's kind of a combination of both, hopefully some growth and income.
Well, this is the difference here too. Whereas if you're in accumulation mode where your tax rate is 30, 40, 45%, whatever, a higher tax rate can hurt. More turnover can result in you paying more tax ordinarily. So that can hurt, particularly if you're in an ETF where it's just flow through straight back to you as an investor. But in a listed investment company, it's also not too bad because it's tied up in the company's own tax rate.
Yeah, definitely. I think it's always, at least they're open on that if you're holding this in a taxable environment, you're going to get a reasonable capital gains tax bills each year because of the turnover and the distributions they're making. So whereas it's hard to determine from each individual strategy whether that's going to be the case or not.
Yeah, and sometimes this is where we rely as investors, or as financial advisors do at least, rely on the the research reports that come from ratings houses. Yeah. Because then they can, using their experience, have somewhat of a prediction around what this might or might not do in terms of the taxable position. So this is a listed investment company. If I'm not mistaken, they also have the unlisted versions as well.
Yep.
Yeah. So what do you find that you're primarily using for your clients?
It depends on whether there's a discount or a premium on the listed investment company. We tend to prefer the unlisted version, just we can control redemptions and applications better, and you don't have that risk of it going to more of a discount or more of a premium.
Yep.
So that's generally been our preference, and it's the same portfolio, the same strategy that lies behind it. So
yeah, right. So this is a really interesting one, the Plato Australian Shares Income Fund. In our Q&A session for the Passive Income series, we had a few questions about how do you find funds. Well, here's another one that you can add to your list. I think last time we talked about the BetaShares EINC, the Martin Curry listed fund as well. Yep. So that's another one that people can put on their watch list. So if this fund is more primarily focused, there's a part of the portfolio that's turning over a lot, would you use this fund in an accumulators portfolio, or would you use something else typically?
I think it's more suited to superannuation, at least super, so 15% tax rate, preferably pension. And we kind of see it not necessarily as a core, but as a complement to your core Aussie equity exposure, where if you feel like you need more income over a period, or you think dividend paying stocks are going to be in favour, then you tilt towards something like this.
Okay. And so I guess outside of this then, actually one more question on this. When you, so say that you came across Plato 10 years ago, but let's say you came across a new fund today, like this one, how would you go about researching this fund?
Just multiple meetings with the portfolio managers is always a start, and research reports, as you suggested. So we get approached all the time to look at strategies. One, we kind of make a call on whether we're looking for that type of exposure within a portfolio. Is dividend income, or is growth, fast-growing tech companies, is that what we're looking for? And then, multiples. It's just a due diligence process. So you'll obtain research reports, find out historical track record, get more detail about the portfolio, understand their approach, and then eventually meet the portfolio managers. I think that's key, and a key role of an advisor is to put the, what do they say, press the flesh or something like that. Which is much easier now. If they're based, I think they're based in Queensland or Sydney, so being able to get on teams with the portfolio managers, and we've done it to managers in New York and Europe as well. I think that's incredibly important when you're recommending things to clients. Yeah,
for sure. And you can always jump on webinars and that sort of stuff if you're not being advised by an advisor, but that's a good way to do it. Okay, so that's the Plato Income Maximiser Fund. But there are many listed structures too, like outside of listed investment companies. We've got funds and we've got ETFs. I'll just rattle off some of the most popular income-focused funds, and this isn't an exhaustive list. We've got the HVST ETF from BetaShares. We've got the IHD ETF, Vanguard VHY, YMAX, which we covered separately in the Q&A session, DVDY, MVB, which is actually not an income-focused fund, but it's actually just the 7 big banks grouped together in one fund. But it's actually produced pretty good returns over the past 5 years. It's beaten a lot of the income-focused funds. Then you got ZYAU from ETF Securities, which is an ASX 300 yield-focused fund, and then RDV from Russell. So these are some of the bigger ones. There are others. Like you can, as we've talked about in the past, you can use a vanilla, market beta index fund to get yield focus. But the principal focus of these is to increase the yield that you would get from an Aussie portfolio.
Yeah, and the ASX 200 is probably yielding about 4% or 3.9 thereabouts on average. So most of these will be yielding in excess of 5 or 6%.
Yeah, and then many of them too, if they have the holding period, they'll also collect franking credits along the way and pass those back.
Yeah.
I guess just if we could talk maybe a little bit about the VHY ETF. I've talked a lot about it lately, the Vanguard High Yield Australian Shares ETF.
Yep.
It is by far the most popular Australian ETF for dividend investing. And I think you mentioned in one of the passive income videos that we did that you use it for that yield focus for Aussie equities.
Yeah, we do. I mean, a key driver of Vanguard has always been cost. So I think the ETF's about 25 basis points.
Yep.
And they've got a pretty, the key thing you need to understand with these ETFs is that they're tracking an index. It's a specialized index, but they essentially track and rebalance towards that index, whereas something like Plato or I think it was DVDY is almost an active management sleeve that comes onto it. Mm-hmm. I think just the transparency and the ability to not necessarily turn the portfolio over, but turn the names and exposures over a little bit more than other index-driven strategies, one of the reasons why we've used it.
Yep. It also, the Vanguard fund, which is it's a good feature of it, uses analyst consensus forecasts for dividends.
Yeah.
Where there are what we call dumb beta ETFs. So these are ETFs that have some sort of strategy which is stupid in that it will end up in yield traps, or it will own BHP right before it's paid a dividend, right before it's announced a cut to its dividend, or own the banks leading up to the COVID crash. And all of these types of supposedly yield-focused funds end up with holding the bag on some value traps, whereas this one uses forward-looking analyst estimates, which helps it. And it combines that with about 60 to 70 stocks, which means that it's quite diversified as well versus some of the other. I think that's a bit of an advantage over the Vanguard fund versus the other funds in the list.
Yeah, I was looking at the Plato website before and they call it naive yield, where you're just buying the highest yielding stock historically, which is more likely to find yield traps. So there's plenty of companies that share price have fallen on the assumption, as you were saying, that analysts expect their dividends to fall, and hence they'll be worth less. But their dividend looks like it's at 15% for the time being. So I think that's a key challenge of investing for income. We naturally gravitate to the highest yield, but having some sort of forward-looking input into that, even if it's data-driven, which is what this benchmark does, I think is incredibly important.
There's some of these ETFs do get quite creative, especially these income-focused ETFs, like the DVDY ETF, which is the VanEck Morningstar Dividend Yield Focus Index ETF, quite a mouthful. This is an ETF that uses basically the proprietary research from Morningstar and then combines it with, so it's got dividend yield focus, but a distance to default. So Morningstar has this thing, it's like equity volatility and financial strength to try and predict companies that are unlikely to they have weakness on their balance sheet in the future. And then it combines that by trying to find quality dividend paying companies. And I think that's quite unique. It's a relatively small fund, around $21 million, $70 million at the time of recording. But it's an interesting ETF, 35 basis points, and you get all of that research in a listed vehicle. I think that's pretty neat.
Yeah, and you can see the differences in the top 10 holdings when you pull that up as well. So if you look at most high yielding strategies, the top 10 holdings, you'd know every name. You could buy them yourself. Yep. Whereas looking at DVDY, and you've got ASX, the stock exchange provider, Medibank, and APA in the top 10, which I know that's only the top 10, but I think below that is you get even more differentiation. Yeah. So one key thing, we manage direct equities in-house. So one thing that's important to know is if you're adding this ETF, how does it overlay or how does it complement what you've already got? Are you just overweighting the same stocks, or is it giving you some diversification, which this one looks like it does? Yeah, speaking of Morningstar, investors, if you do have a Morningstar.com membership, you can actually use that website to put two funds side by side and have a look at the different holdings and how they overlap. And there's also a free tool from Vanguard. If you go to Vanguard Tools, and you can do a fund compare, and you can see the overlap in the top 10. Yeah. But this is an interesting one because it's on the early days for it, but it's relatively low fee. It's a pretty smart ETF in the sense of how it is constructed. You could probably say the same for the ZYAU ETF from ETF Securities. Its 5-year track record hasn't been as impressive, but it holds around 40 companies. It's got the shareholder yield focus. It does something similar in that it's trying to find companies with sustainable yields. And this is to your point, the way they measure that is, so they've got the total shareholder yield is the total amount per share distributed to investors, combining both dividends and share buybacks, divided by its share price. So they're trying to find the yield and then how much is it paying out in dividends and how much is it earning to make sure that the dividends being paid out are funded by the profitability of the company, not by capital raisings and not by debt. Basically, so net shareholder returns. So
exactly,
what you're not just buying it for the income stream. Otherwise, you're effectively buying a bond. Is where you get no capital growth. So, I think it's unique strategy. We've used this in the past as an income overlay as well, and it kind of reminds me of. Have you got the yield on that one? 4.4. So not significantly higher than the market, but it reminds me of. I think I mentioned it last time as the Dividend Aristocrats, where. They basically increase dividends for 25 years to be considered an aristocrat. But if you look at it now, most of them are only yielding 2 or 3%. Yeah. So it's not about that headline yield, but the growing cash flow behind it. And I think when you're looking at companies that are buying back stock as well as dividends, it can be reflective of that as well.
The one that's interesting is, I don't know if you know it that well, but the HVST ETF or fund from BetaShares. It's the modified ASX 100, and it actually holds the A200 ETF there. Australia 200 ETF, and it basically uses part of the portfolio just to target the dividend yields that are coming up before the next rebalance. Yeah. And so this might be one where as an accumulator myself, I think, it's probably not right for me because it's turning over the portfolio. There's probably going to be taxable gains in there. But maybe if you are in that zero tax bracket, maybe it's something that you look for. I would throw a bit of caution here though, that it does come with a fee load of around about 90 basis points.
It's about similar to the Plato strategy. Yeah. So 70 versus, I think Plato was 80 or the LIC was. Yeah. And I mean, it shows you the ability to, if you specialize in a single area, you can find an edge somewhere. Yeah. And I mean, part of this specialty is analyzing balance sheets to find out who's got the biggest franking credits and trying to buy those stocks before everyone else does and sell them on the other end.
Yeah, no,
there's that kind of unique thing about the unique tax system we have where you get franking credit refunds. But when the dividend's announced, the stock price never falls by the franking credit, only by the dividend.
Yeah.
And part of that's because a lot of global investors are the ones holding the stock, so they don't have value in those franking credits. And that's where things like HVST and Plato can jump in there and boost returns.
Just past performance is not indicative for future performance necessarily, but the Plato Australian Shares Fund has returned around a total fund return of around 10.2%. And it's interesting, it's 10.3% returns per annum in income and negative 0.1% in capital growth.
Yeah.
So it gives you a sense of it's all coming from the income component of the fund.
Yeah, and capital, obviously they're returning capital in the form of capital gains too. So it's kind of what you'd expect. If you're getting 10, you're probably happy though.
Yeah, definitely. Well, to put it in context, this modified ASX 100, the HVST ETF from BetaShares is 2.66%.
Yeah.
That was my numbers. So I guess it's a bit of chalk and cheese there, but maybe there's this is where an active fund actually does pay literal dividends to have that focus where you can take it and make it smarter. And as you said, build on that IP that they have. This is not an endorsement for Plato, by the way. It's just something that we've just come across. So, yeah.
Yeah, I think completely right. And I think it can be difficult to actively, an active dividend paying strategy based on a benchmark, if that makes sense. So an active benchmark versus true active management. I think it's kind of, you almost need to be one or the other. You need to be just following an index or full active, which is probably the...
And this is because I feel like it can get hard for some, because if they're automating it, chances are someone else is already automating that through a quant strategy or something like that as well.
Yeah.
And I mean, every investor in Australia basically knows dividend harvesting and how that works and how you target the next dividend payment. I mean, you can go on Market Index, the website, and just go upcoming dividends if you want to.
Yeah.
And so, I mean, I think it needs to be a bit smarter than that, and maybe that qualitative approach is where it comes in. Just one thing here. I mentioned the MVB ETF before, which is this bank's ETF. It's very concentrated, 7 positions. Would you ever consider, say, having a diversified Aussie shares ETF, say VAS, A200, STW, whatever, and then using the MVB ETF to get more exposure to financials? I mean, it's 30% anyway, but...
Unless I had a, really high conviction view that the banks were super undervalued. I didn't have the view in March 2020, but this would be, in crises, this would be the perfect investment, because everyone thinks the banks are going to go bankrupt, but they never do. They're inherently supported by the government. Yeah. So I think if you're buying an ASX 200, you've already got 40% or 30 to 40% in financial. So it doesn't necessarily make sense to double overweight it. I think perhaps if you've got a fully active portfolio where it may hold less exposure to the banks, then something like this might make sense.
That would make sense, because I was trying to figure out, I just asked VanEck, where this MVB ETF comes from. Who is it targeting? Because the other thought that I had is, say, for example, I'm an active investor. You could say I also have ETFs or whatever. But if I don't own any bank stocks directly, so I was thinking maybe instead of trying to pick CommBank or NAB or whatever, you could take a whole of sector approach and say, I don't think bad loans are going to be as bad as what they say, and high interest rates will be better for the net interest margin, so on and so forth. Maybe you could take a tactical view with it.
I think it's probably geared towards the more professional, almost stockbroker level, where they'll have an entire sector view, where they'll say, the banking sector is undervalued. Our more of a 3 to 6 month strict or tactical decision than holding it core alongside other things, just because of the additional exposure that you get. And then if you're holding, or if your client's holding direct equities and you want to, they're underweight. So if you're holding direct equities, you're generally going to be underweight to the financials compared to the index. Then you might add it as a complement to increase your weighting that way. But it's hard to see it, with an ASX 200 next to it.
Yeah, okay. So the final one, which it's probably worth mentioning, is the Russell Investments High Dividend Yield Australian Shares ETF. This is an ETF that has performed pretty well over time. And just to read out what it does, it seeks to track the Russell Australia High Dividend Yield High Dividend Index. It's Aussie blue chip shares with a bias towards those that have a high dividend yield, but that also have a history of paying dividends, dividend growth, and consistent earnings. So it's basically just taking, historical patterns and saying what is likely to pay in the future and is it growing. Pretty simple strategy, but it has produced pretty decent results. And I think, again, what I've noticed from looking at these ETFs over the past few weeks is that, and over these few years, I should say, is that the more diversified funds tend to be more all-weather than those that are very narrow. Sometimes these rules on the Australian market can result in 20 stock portfolios, where the broader focus tends to yield better returns. I guess that maybe, if I could just riff on this for a second, it could be that, 6 to 12 months ago, maybe 12 months ago, no one was really looking at energy as a sector to earn yield. It was pretty unloved. And now all of a sudden it is the sector paying the massive dividends, right? And so having some exposure to those sectors through diversification is that what can give you that extra few basis points.
Kind of relies on that forward-looking approach as well. What you want in a dividend-focused strategy is a focus on companies that have got good cash flow. You don't want dividends like pre-GFC where dividends were being paid from higher gearing or from asset revaluations. You want them to be driven by increasing cash flow, and you have to have cash flow to really pay out strong dividends and to grow them. So, and you need a forward-looking approach to see that energy prices in the next, energy stocks in the next 6 to 12 months, or even associated stocks, are likely to pay higher than usual and consistent dividends for at least a period of time.
Yeah. Maybe I'll ask you for your favorite in just a second, but have any of these ETFs, I guess, made their way in or out of your clients' portfolios recently? Like, have you changed focus in the last few months at all? Like when you did your last investment committee meeting, were there any wholesale changes to Aussie equities or yield-focused funds?
Not to Aussie equities. They've kind of held up reasonably well. So no major changes. I was just running through a few updates for clients then where the mid-cap strategies have kind of underperformed versus the Vanguards and anything with higher commodity exposure, which has done well. We probably removed, so Plato we've held at different stages, but it was removed pre-pandemic when we kind of switched from an overweight to dividends to an overweight to growth and benefit a little bit from that. So we kind of view it that tactically, not 3 months tactically, but a year or two. And there's stats out at the moment that show it's something like when the majority of your returns come from capital growth for a period of 10 years, it's more likely that majority of your returns over the next 10 years will come from dividends. So it's becoming of interest again, and particularly when generally Australian companies are pretty strong, given we've been a beneficiary of everything that's happened in the world. Somehow.
That's interesting. So over 10 years, you've got that capital growth. I mean, it makes sense. Those companies then transition to paying dividends and dividend yields become a focus. I think that's what we're seeing now is people are relying on that income to protect their downside in many instances. They're relying on the BHP to pay its dividend, CommBank to pay its dividend, and hopefully that underwrites some of the poor performance from the capital perspective that we've seen.
And that's a consistent story in tough markets. So maybe not the GFC when dividends were cut initially in 2020, but during down or flat markets, just reiterating that you're still getting 4 or 5%. Yeah, you're not getting the capital gains, but no one is during that period. So dividends can be a consistent source of at least some return, even if capital is going sideways in difficult markets.
Okay, so question for you then is, like, of these funds that we've looked at today, which of those would be highlights to you or like worth people putting on their watch list?
Vanguard for sure, definitely. That's the boring answer. You've actually surprised me on a couple of them.
Okay.
So I don't mind the DVDY. We get Morningstar research, and they're inherently value oriented, as you probably explained. So I kind of like how defensive and how conservative they can be. And then the portfolio is a fair bit different to a lot of other portfolios. So
I like, so I've only looked at Plato in the past, but I've known about Don for quite a while because of his expertise.
You've interviewed him, haven't you?
No. I was going to, so hopefully I can have him back on the show and we can follow up with this conversation. But I do like Vanguard VHY for me is pretty rock solid. It's hard to go past, particularly if you're in accumulation mode. There are other listed investment companies, perhaps there's a full session on this, but there are many other listed investment companies that offer the franking credits plus growth that so many people would be looking at. And I guess I do like the Russell strategy as well. I think it's got about I've just off the top of my head, $250 million odd invested into it. But RDV is another fund that I think is very simple in its design, but it's also quite elegant, and it gives you that exposure for 34 basis points. It's pretty nice and tidy there. But yeah, for VHY, for me, for accumulation, I think this is where we differ, where we had to chat about the passive income series about listed investment companies. I do actually like listed investment companies from the perspective of franking credits and capital
smoothing.
Smoothing that capital gains bill.
Yep.
So I do like some of them. Maybe we can do another session on them. But in the meantime, if you're looking for ETFs, I think VHY should be on a watch list. I'd be wary of some of the ETFs that rely on shorter term strategies like harvesting or derivatives.
Yep.
I just think it's probably for most people, I don't know if it's necessary complexity. I just think maybe they're more, and they tend to have higher fee loads because of that more active bent.
Particularly in a more volatile market, I think.
Yeah. I just think maybe just keep it simple for the yield focus. That's my 2 cents. All right, mate. Well, that's our conversation. The top ETFs and funds. We brought Plato to the table. Don't forget the BetaShares EANC ETF as well for a watch list, or fund, I should say. But hopefully we can come back and we can talk about listed investment companies sometime in the future.
Thanks again.